Okay, this week's Q&A. 60 comments. I don't think they're all questions. Some are long, as I was expanding the each comment so that we could read it. I may not get to every single question every person has, but I will do the best I can here. In your applied series, you taught how to sell in the money short puts every 2 to 3 months and use target prices of stock as strike and roll it every 2 to 3 months as a proxy to own the stock. So when we look at a particular stock and you look at the options price, the options, the center of the distribution, let's say you're going out 30 days, will not be the current price, which is why the further out you go, you'll notice the 0.5 delta strike prices are not always just at the same price where the stock is, because it is the options are centered around the forward price, not the current price. If you have a belief that the stock will rise according to that projection, then if you're selling an at the money put, it would be based on, if you're going out 3 months, it would basically be in the money based on where the current stock price happens to be. This is if it's not paying any dividends. But this is not, I wasn't recommending that you sell it on that forward curve. I was recommending that you basically sell it on what your forecast was. So let's do another one, and let's say you saw a stock, with this kind of pattern, and you wanted to sell puts. Well, you have this kind of pattern going on that if you want to sell at the money puts, by the time the stock price gets here, there's not a lot of premium. You're giving up quite a bit. That if you think that this is the support line, 30 days out, 45 days out, 60 days out, you would try to sell on whatever you project the support line would be. Is just a more effective way to sell puts, as opposed to saying, well, here's at the money, and I'm just going to say, if I'm going out 45 days, if the stock's at $50, I'll sell a put with a strike at 50. Whereas if you're going out 45 days and you project the stock price out 45 days, you might find an at the money put has a higher strike. Let's see, where do we leave off? I used 2-month period and got assigned pretty quickly due to higher delta. If you were trying to do that based on a stock that didn't have upward support, it's you have to project out where you think the stock will go, not just use what the forward curve or what the forward price will be, because let's say the stock does this. Well, that's its forward curve. The next day the stock could be down here. Well, there's the forward curve. Then it could do this. Well, there's the forward curve, right? So it'll keep changing based on wherever the ending price happens to be. It's an improvement to just looking at the stock price today, going out 2 months and selling an at the money, what you think is at the money, because a $50 stock today, well, I'll use a $50 strike 2 months out. It's just an incrementally better way of doing something if a stock is trending in a particular direction. But if it's not, then, well, it's probably not going to work out. Let's see. So we'll, I think we answered that. I keep hearing short beta long duration motto as your overall market outlook. I agree with this and can understand it theoretically, but I was wondering if you could share any mathematics, code, etc. to calculate these on a portfolio level. Not really. I'm short ES futures, so I don't need a calculator or any mathematical model to know that I'm short ES futures. So I'm short beta. I am long TLT calls. Again, don't need a calculator or any mathematical model to know that I'm long calls. It's just, that's the position I have. I don't know that I need to calculate anything on that. My portfolio is mostly options on futures, ES, gold, silver, oil, and ZB. Well, when you say options on futures, I'm not sure if you're long the options or short the options, but okay. I've been using 52-week returns on SPX to calculate the beta of each position. You should have uncorrelated positions here, or very low correlations between these. Yeah, you should have very low correlations. I prefer to look at beta weighted delta rather than just beta. Yeah, I agree. But I cannot create similar portfolio measures for duration. For simplicity, let's assume we're looking only at the front month GC futures, gold futures. How would you calculate an accurate duration on the gold duration? I don't know where you're going on this. Let's clear something up. Accurate duration. There's no such thing. Duration is an estimate at best. It is a theoretical estimate, period. Empirically, we don't really see the price reaction to changes in rates following along with duration unless you have a very clear fixed income security with no other risk premiums in there. Then it comes fairly close to the effective duration of whatever it would be, but duration is just an estimate. That's all it is. Period. There is no such thing as accurate duration or interest rate sensitivity like beta. Well, I don't know that beta is an interest rate sensitivity. I don't know how to answer this question because to me it seems all over the place. I don't know why you're using the front month gold and you want to calculate duration on the front month gold. Are you trying to determine how sensitive gold is to changes in interest rates? If you are, you're probably looking at a spurious correlation. Gold will respond to the price of the dollar, the value of the dollar, more than it will respond to interest rates. So you got, the U.S. dollar will affect GC, but interest rates, the direction of rates, will affect the U.S. dollar. You're sort of just going around it and looking at rates on gold, where it's more heavily weighted on the U.S. dollar. Rates will affect the U.S. dollar. It's the U.S. dollar that is more proximate to gold. But this idea of an accurate measure of duration and getting mathematical, that's all fantasy. Most of the calculations of beta and duration are your best estimate based on the data that you happen to have. And duration is really theoretical. That's all it is. It's just theoretical. So sometimes it will respond more than it should, sometimes less than it should, sometimes it won't respond at all. So I don't know that you can get more precise than saying I'm short the futures, hence I'm short beta. I think that would be enough. Looking at the copper and mining argument, I reckon that the initial green transition crunch will benefit the forges and electrical wire manufacturers first, as they will see initial final demand and increase their investment in initial production. Only after the capex investment in the later stage production starts would the miners truly rocket to new levels. Why? I'm wondering if you looked at taking a position in any companies down the production, but why? Why? I mean, if there's more demand for electric wire, the electric wire company has to order copper. So I'm not sure why I would go that far down towards final demand and work my way backwards on that one. I guess I'm not understanding how electrical wire manufacturers can increase production and capacity and output without ordering more copper. Like, wouldn't any increase in demand for wire be an increase in demand for copper? Period, I guess. So I'm not sure. I think what you might benefit from is to Google something called the Hayekian triangle. Google the Hayekian triangle. That might help put the supply chain, because it's basically based on a supply chain, where you are in the supply chain. This is closest to final demand. This is the beginning of the supply chain. And it has, depending on where the interest rate is, it has different slopes that you can look at. So Google the Hayekian triangle, and that might help you out a bit. Let's see. I understand that you're adding to your positions in mining, housing, and mortgage REITs. I am doing that. I also sold puts on the copper futures today at 335. Not 335 in the afternoon, but at a strike price of 335. I sold puts on that. I sold more puts on COPX as well. In previous videos, we talked about the Mexican peso and the long position you have there as well. I don't have that long position anymore because I thought, I never thought I'd see 17. I just thought that, from the 20s, it might be enough to print, maybe the upper 18s. And then it went through the 18s into the 17s. We're at 17.5, and now I'm sort of praying for a pullback on that. In the last year, I've come to the conclusion that with the restructuring of globalization because of the Ukraine war and supply constraints coming through China, countries like Mexico are primed and ready to pick up the slack in production of supplies. If I were to express this view in the market, would I start building a small position in Mexican equities? There is EWW, which has been stable in the market. EWW has responded to the increase in the peso. It is, if you look at its chart, I think it's at multi-year highs. Let's see, but I'm looking to builders in Mexico such as Cemex. The cement company, are they, I'm not sure, I think they're state-owned like Pemex, the oil company is. Is the Mexican government a historically corrupt government? I don't know if I'd go that far. A huge risk to your peso position? Not really. No, I don't know that I would be concerned with the government. No, not really. Thank you for your weekly reviews. As per the put-call parity principle, the discounted value of future dividends are baked in the option price. As such, for high dividend stock with liquid options, the price of the at-the-money call should be lower than the price of at-the-money put. The further out you go, that is true. The further out you go. So if you have a stock that has quarterly dividends and you're at this point in time and the next dividend is this point in time and you're looking at options over here, nothing's going to be reflected in there. Let's see. However, I've observed that sometimes that's not the case. Well, you're probably finding something called the volatility smile. So if you find that the call is priced higher than the put, even though the put should be higher because of the present value of the dividends over the period of time, look at the volatility. And you probably find that you have a volatility smile going on, which means that there is demand for calls, and demand for calls will push up the price. And you'll have higher, this is implied volatility over here, you'll just have higher implied volatility on the call. So when you see something like that going on, that seems like a marker for a volatility smile. So have a look at the term structure of volatility and see what it looks like. Well, that wouldn't be the term structure. Have a look at the skew. You want to look up skew. Term structure would be the chart that comes below it, that gives you, the further out you go in expiration, it gives you the term structure of what implied volatility looks like. But you're probably got significant smile on your underlying. What is the reason for that? More demand for calls. What trading opportunities open up from that divergence between calls and puts? I don't know what trading opportunities there are unless I know what the underlying is and I know what the story of it is. The smile itself doesn't really tell me much. To say this underlying has a volatility smile, what should I do? I don't know. What's the underlying? What's going on in the world? Where is that stock price? What's the story around it? Does it have the word AI in it anywhere? If it does, it'll probably have, significant smile, almost a smirk on the left side. Let's see. Wanted to know how you structure your way of learning a lot of new things in a short span of time. If you could just share your thoughts. Learning is incremental. It is absolutely amazing how much builds on things. That you can read something that you think is unrelated to anything else over here. And you'll find that that every time you read something, it's a brick on a wall, that you're building over time. And then sometimes you'll read something else and it fills in the gap between certain things, and you'll make this big connection. And you have this emergent knowledge. And emergent knowledge is knowledge that you create from the existence of other things. So you may know this, and you may know this, and you may know this, and then you learn this, and you say, well, wait a minute now, I'm seeing something here. And you end up with this new level of knowledge that you didn't read anywhere else, and it just emerges at the level. It is the wider and the more you explore. I highly recommend that. Explore philosophy, explore science, explore history, explore biographies of great leaders in the past, controversial leaders as well. Even though the world today likes to cancel certain people because they said a terrible thing when they were 12 years old, even though they saved the world. They said a terrible thing when they were 12. They were a bully to a girl. Oh, you got to tear down the statues now because of someone. Read. Don't even a biography of Hitler, I'll tell you something, has insight in there, has something that you can learn. Because wasn't a good guy. Reading his Mein Kampf or his biography or something, even stuff like that, I wouldn't shy away from. There's always something that you can pull away from there as what went wrong, what went off the rails, and that's it. It's just read. There is no incremental value to plopping yourself in front of Netflix for 5 hours a night and entertaining yourself. There is no incremental value to it whatsoever. In fact, I would say it even softens the brain. But if you go on to YouTube and you just type in history videos, my God, the library that exists for you. Type in philosophy videos, the library that exists for you. And just sit back and grow your mind, grow those neurons. It is additive, incrementally. So, let's see. I'm a subscriber to the Applied series. Are you going to add any software for finance course? Yes, I am. But for the Python and the Excel, it won't be me because I can find somebody who's far better at that than I am. I have a certain skill set with Excel, but I'm nowhere near the level that somebody who really knows Excel would be. I do still have to look up things and I want to do this kind of command in this cell. Is it even possible? I still have to look up more advanced stuff, and I don't know how to use any of the VBA when it comes to Excel. So it won't be me, but it will be somebody that will do that. The really intense financial modeling course that I'm putting out is next August 2024. This August is portfolio construction and management, which is it's going to be like a 5-6 month sort of course, a week, every week something new to get through the whole thing. The financial modeling comes next year, so yeah, it will be covered. Let's see. Your segment on CDS. I'm curious to know what conclusion we can derive as retail investors. As retail investors, nothing. You can't engage in CDS anyways. It's OTC, and as a retail investor, you're not going to be a significant counterparty. So you can't really participate. You can't sell a CDS. You're not an insurance company. If you could be a counterparty, you could buy CDS, but now you're paying a premium to somebody else to protect you from default of U.S. government treasuries. I can't think of a bigger waste of money. May as well just give money to charity. I can't think of a bigger waste of money. Really, I don't understand why there's a CDS on government treasuries and why the spread is widening. They're not going to default. Maybe a technical default where they get to a day where they have to pay these things back, and they say, well, we're not going to pay you back today. We'll pay you back in a couple of weeks, but accrued interest will still keep going. You're going to get your money. So I don't know what kind of conclusion you can derive from that other than I see it as a buying opportunity on the 30-day. That's all. Seriously perplexed after CPI and PPI data came out, and market pundits, news outlets, and various participants were chanting that this was it. Inflation was clearly in a downtrend, or in some cases I even saw comments that the Fed had won and the Fed no longer needed to raise rates. That's not what Fed participants have been saying. Last week and this week, with all the Fed talk that has happened, I think Bloomberg had 3 interviews with Fed officials, and none of them are declaring victory. None of them. In fact, Bostic is saying that we may even have to still go higher. So yeah, I'm with you on that. I don't know what everyone was looking at. Month over month, it wasn't that great. Now year over year, yeah, inflation is still coming down, but month over month, everything went up. So I'm with you on that. I read both charts the same way as you did, and the above assessment is clearly wrong. This is a tough question, but how can so many people, pundits, news outlets, get it so blatantly wrong? Well, from their perspective, I've got it blatantly wrong, right? Just goes to show how important it is to do your own thinking and not outsource it to others. The Monday, I was, looking at the market and thinking, it's just not responding to anything the way it should be responding to it. This willingness to look past everything, to me, just seems folly. And as much as everyone knows, well, the rally came from 5 stocks. The mega cap, big tech, still overvalued. Everyone sort of agrees with that, and yeah, we're going to retest the lows. More than 50% of analysts out there, I think, believe that. The sentiment is there that this is a multiple that's not justified by the climate we're in, but we just don't go down. We go down, sell off 11, 12 points, and for some reason the market sees that as a fantastic buying opportunity on the pullback, buy on the dip. You'll never get a chance like this again. And it just, you got green bars right up the side of the chart. It has been very frustrating, but I think what we have is, with every Fed speaker, with every data point, you have another straw on that camel's back, another straw, and I don't know which straw it's going to take, but it's going to break. Today, May 16th, was, it was a little bit more consistent with things. For example, rates were up and REITs were down. That's consistent. That's absolutely consistent. The IYR was full of blood today. That is consistent. But I have seen it where rates are up and REITs go up. And it's like, REITs, I don't think you're getting the message here. Rates higher for longer. You haven't priced that in yet with the cap rates you have. Well, today I think the REIT sector really got the email because the blood was pretty intense in some of the REITs. Even some of the apartment REITs that had held up quite good were starting to show weakness. And it makes sense that they should, finally. But hey, listen, that could all reverse tomorrow, and tomorrow we could be in fantasy land all over again, where, something that should go down goes up, and you're left scratching your head going, I don't understand the reaction of this. But a couple of weeks now, almost a month, I've been in awe of the market's ability to ignore basically everything. Yeah, there's been some good news. But when you're faced with the level of uncertainty we have, you have a debt ceiling date approaching. Yellen saying that, this has got to be done. And she's saying June 1st. You got McCarthy saying we're nowhere near where we need to be. You have clowns that are running the show now that, are they even going to get anything done? You have a Fed that maybe is on pause. Maybe they're not on pause. You don't know. And no one is cutting rates this year. No one, unless something really breaks. And with all of that uncertainty, to trade at a multiple above an equilibrium multiple on earnings that have been coming down, mind you, not as bad as everyone thought, but they have been coming down, to me would warrant a multiple maybe 1.5 times lower. Okay, don't go to 14 times or 15 or even 16, but 17 is not unrealistic given the level of uncertainty we have, but absolutely not. If you are confused, I am confused as well. And I've heard other analysts on Bloomberg say that they've never seen a more confusing time in terms of what strategy to follow, that they are just befuddled. So I'm not alone. I remember very well your rationale for copper, mining, and housing to be high conviction plays, but not for mortgage REITs. They are obviously correlated to an eventual increase in housing supply, but beyond that, could you elaborate on it? Where the mortgage REIT typically is primed for purchase is when you have a very steep upward sloping yield curve. That is usually the best condition under which to buy mortgage REITs, because if you have this, they've lived through the worst of it. That was the worst of it, and spreads are the widest. Well, that's what you have right now. Spreads are the widest they are right now. So you have to make a distinction between demand-driven business cycle and supply-driven business cycle. Demand-driven business cycle, you have expansion and rising inflation and rising rates, along with shrinking spreads. Spreads shrink until things break, and then spreads really widen. Rates drop. If you have supply-led business cycle, you aren't going to have this kind of growth. You'll have more modest growth, it'll look like a slowdown, and you'll have rising rates and rising spreads. Here with demand driven, you have rising rates but contracting spreads. Here you'll have rising rates and rising spreads. So you get it at the top of the cycle instead of the bottom of the cycle when it is supply-led inflation that you get. So the correlation between here you have a negative correlation, here you have a positive correlation, so that the spread tends to be widest up here. So agency mortgages, if you look at the credit scores backing them, are very strong. The agency mortgage is guaranteed by an agency. So if you're buying the MBS itself, you're good. Thing is, you're buying a company that buys MBS, hedges out the interest rate risk, and levers up the spread. So you have operational risk on top of all of that. So you have to buy very good companies. Annaly and agency are good companies. If we look at how they're handling where they are now, they have reduced the amount of leverage they use. They are producing great net interest income and dollar roll income. The losses that they show are, well, they're holding assets that as interest rates move up, the price drops. I'm not concerned. I'm not concerned with them. With the spread as wide as it is, it's not going to stay there. That spread is going to contract at some point. And when it contracts, because they isolate the spread and they lever it up, they should do very well. Any explanation for why the 1 month is so much higher than the Fed funds rate? Well, everyone's worried about getting their money back in June. right? In June 15th, the Treasury gets money from tax installments. So everyone's trying to avoid a Treasury that matures before June, or before June 15th, and trying to pick one that expires after June 15th. Why do yields on the long end of the curve typically drop when either a credit event happens or when we enter a recession? Because the expectation is that the short rates are going to drop, and if short rates are going to drop, then long rates, if you have an elevated yield curve that is inverted and short rates drop, long rates will drop as well. Short rates really drop, and you'll end up with your upward sloping curve at that point. So the long curve reflects economic conditions. The short end of the curve reflects monetary policy. Let's see. Very satisfying to watch Druckenmiller's interview and learn that both he and Meldrum are excited with copper and housing. Also mentioned biotech, AI, and infrastructure as investment themes for the next cycle. Are you also playing those, or can you share any thoughts about that? AI is already hyped and overvalued already. You're buying a whole lot of hope. So I don't, who's going to be the winner? Nobody really knows. Is it going to be a company that provides AI? Is it going to be a company that uses it? Right? So I don't know where the winner is going to be. Biotech is just something I don't understand. This guy's got a team. This guy's got a crew. This guy's got a team of people working in a room every, I don't know, Thursday, I guess, is presentation day. Take a day. I don't know which day it would be, but it'd be presentation day, and every team comes in and pitches their best ideas. Well, if I had that, I'd be all over the place as well, right? You can't possibly know everything. And if you're large enough, you got a team that is bringing ideas to you. Do you separate copper from metals in mining? I have some PIC exposure, but this is heavy on iron ore, which depends a lot on China. Also knows Freeport is not top 10 holdings of COPEX. Was in the top 5 at one point, but other companies just got ends up their market cap just grew bigger. I've been selling puts on COPEX and Freeport and Rio for copper exposure. I think the big companies will just get bigger because they will acquire, and you're seeing a lot of acquisition in that space to get copper, to get more copper reserves. One statement, one question. Would love a video about how you read, review academic and working papers. Do you really want to know how to read an academic paper? It's boring. There's really not much to really get out of them, and they're really boring. And for the most part, unless you have read academic papers and you speak the language, the author is not talking to you. The author's talking to about a dozen people in the world, and that's it. And the author is assuming that you know exactly what they know, and will take no pains to. You don't learn from it. It's not meant to teach you anything. It's a research. Academic papers are research papers meant to add new knowledge, and you can't just say I've created new knowledge. It's all peer reviewed. Your peers determine whether or not you've had new knowledge, and then it gets published, and then it won't be long before somebody publishes something else that says, no, it's this variable in fact, and somebody say, well, no, it's this variable in fact, and 20 years later there might be a consensus, and maybe then it finds its way into the textbook. But I don't know that you want to read this stuff, really. What are your thoughts on student loan forgiveness situation? I don't agree with it. I really just don't agree with it. You are asking 100% of the population to pay for an asset that 20% of the population own? I don't agree with that at all. Not one bit. this is nothing more than, you're going to privatize the gains from education because the gains accrue to me, but I'm going to socialize the cost of it and get everybody to pay for my education. What the hell is with this student loan forgiveness? I don't understand why we think that education is a cost, but housing is an investment. Who came up with that stupid idea? The returns to education throughout history have always far outstripped the returns to real estate. But yet we call real estate an investment, and no one would ever decide to float the idea of mortgage forgiveness for everyone. Let's have some mortgage forgiveness. And not even just mortgage forgiveness for everyone, but mortgage forgiveness for a small part of the population. Let's forgive the mortgage for 20% of mortgage holders, and we'll get all the other people to pay for it. That would never, ever work. But for some reason, we think, well, with education, okay. Some pushback on that might be, yes, but some degrees are never going to pay for themselves. How is that society's fault? How is that the taxpayer's problem that the person chose poorly? I'm sure when they said to their parents, I'm going to take a double major in history and liberal arts, that dad hung his head down and said, Dear God, what a waste of money this is going to be. That nobody told that person that you really don't need that kind of education for Starbucks. You can head right to Starbucks right away. No, I absolutely disagree with the idea of paying off somebody else's asset. Now, if you say, I tell you what, we'll pay off your student loan for you. However, we now own some of your future income beyond your tax rate. We are now a partner in your future income. We own equity in your future income. If society is going to finance this asset for you, there should be a long-term return on this asset. You could say, but that's your tax rate. Yeah, but that's your tax rate anyways. For all those people who paid off their own student loans, they got the same tax rate. So you can't just say, oh, the tax rate that I would pay anyways, that's what you'll get from me if you pay my education. No, because we would get that anyways. It must be a higher tax rate. It must be some percentage of your after-tax income that flows back to the state in perpetuity. If you want the state to pay for your education, to give you this asset, then they must have a return on this asset. But it can't just be an expense. I think it is ridiculous. And anyone who says, oh, but I can't afford this or I can't afford that, well, don't buy a house then. Because you'll say the same thing, and then you'll be saying, but the taxpayer should pay for my house. What about your car loan? Should the taxpayer pay for your car loan? Just because, oh, if I didn't have to pay for my car loan, though, I'd have more money to spend in the economy. Well, I guess I'm going too far on this, but my opinion on this is that I think it's ridiculous to expect a truck driver who has to work 60 hours a week to get by to start ponying up tax dollars so that somebody who took a liberal arts degree can get it for free. I think it's absolutely ridiculous to expect that. But it's an idea so ridiculous, I think only a liberal could come up with it these days. I want to bring your attention that GM's present book value per share stands at $49.91. Maybe $39.91? I don't know, but $49.91. Well, the market price hovers around 32. Curious about why a company might trade below its book value. Well, there could be a thought that they will destroy their own book value, that their investment in EV will not pay off, they will not be profitable, they will not compete, they'll waste billions of dollars of shareholder value, and the ICE side is simply going to disappear and go away, so that the assets that are in ICE, that are on the balance sheet, really aren't worth what they're listed at. I'm not suggesting that that's what's going on. I'm saying that if you want to explain why a company is selling for less than its book value, it's more than likely the belief from a significant number of shareholders that they're simply going to destroy that value anyways. Um, Considering the promising growth prospects in the EV sector. Well, yeah, there are growth prospects in the EV sector, but are they GM's growth prospects, right? Or are they Tesla's, BYD's, and all of the pure play companies? Are they? Is that industry? Does it belong to them? I've noticed that the recent buyback hasn't impacted the share price significantly. In light of this, what suggestions do you have for management to support the share price? This is going to be a show me stock. And there are some stocks that are hope stocks where all they have to do is say a few keywords and up they go. And it does not matter what their fundamentals are. The fan base will support a higher multiple just to support a higher multiple. There's no reason at this point Tesla should be trading at the multiple it's trading at, but there it is. Whereas GM is going to be a show me stock, which means that they actually have to sing for their supper every quarter. And maybe they get respect, maybe they don't get respect. But at some point, the amount of free cash flow they generate is going to have to be taken into consideration. It doesn't help that Warren Buffett mentioned, or that we know now that Warren Buffett sold 20% of his GM position. That doesn't help. So, it took it hard today. But yeah, it is going to be a show me stock. I think Mary Barra made some missteps. The first misstep was not IPOing Cruise when autonomous driving was all the rage. When it was the buzzword, you could have IPO'd that for $50 billion, which is more than what GM was worth on its own. Inside GM, it's just not being valued very highly. Outside GM, it would be high. It would be valued significantly. Why they are not IPOing that, I really just don't know. I certainly would have advised that heavily. That when they didn't, it was sort of a bit of a blow. Why they waited so long to reinstitute a dividend and then to make it such a paltry dividend, I don't get that. If you really are producing the type of free cash flow, and free cash flow means after your capex, if you are producing that free cash flow, return more of it to shareholders. Do something. But at a certain point, you have to look at management and say, I don't know. I was wondering, with respect to allocation, do you have some kind of rule that you will keep about 5% dry powder? I see that every week you're looking to open some positions. Just wondering how much dry powder you keep. Right now I got a lot because I am underinvested. So I do have a lot. And I am really looking to be fully invested, but I can't commit to being fully invested because I know what's going to happen. As soon as I'm fully invested, we're going to drop 30% in 3 weeks. I know it. The universe is waiting for me to be fully invested. Anyone else feel that way sometimes? That the reason the market is going up is because you're not fully invested? But if you got fully invested, that's the end of the story right there, that you're the event. Some days I feel like I'm the event. On my paper account, I'm using about $400K of the $1 million margin. This would be considered a bit of an underutilization of capital. Well, your other $600,000 is earning a cash rate. I mean, you can think about it that way. It is earning a cash rate. Just get more aggressive. You can say, well, look, you could go from 400 to 700,000 investment as long as you add some short stuff somewhere. Or some negative correlated stuff, or some uncorrelated positions. So the Canadian dollar pullback today, along with Canadian inflation month over month coming in super hot. If you look at the month over month number, it was almost double expectations. I think it was like 0.7. That you annualize that month over month, you're over 8%. Which brings the Bank of Canada back into play for another rate hike. So being that Canada has significant amounts of copper as well, and potentially lithium mines and rare earth mines or deposits that haven't even been exploited, it could in the next cycle be a very well performing currency. It is weak right now. I've been puzzled at the weakness of the Canadian dollar sometimes, being that the Canadian Central Bank was ahead of the US for a while. The Canadian dollar just continued to get weaker and weaker. And even with the inflation read today, I thought for sure it would hold its ground, but it started giving back. So I started selling 74.50 puts for the July expiration on the futures. And I will continue to add to that position. I think being long the Canadian against the US is probably a good idea. So you can find positions that are uncorrelated to the equity market. Other things that you can do as well is you can start thinking about the XHB sitting around $70 right now, selling puts on these, the 68 puts, the 67 puts on these. Regional banking, XRE, sitting around, 37 now. You might want to think about the 34 puts. Lots of activity on the 34 puts today. You might want to think about adding these puts because I don't know how much downside there is here, but if there is, it's going to be commercial real estate related, which is operational as opposed to structural. A structural issue, it'll be operational, and I'm sure there'll be enough private debt that comes in and enough workouts from banks to avoid the worst of it. But you may want to dip your toe in there a little bit. I wouldn't get aggressive, but there are things you can do to increase your positive exposure in ways that are as uncorrelated as you can get. 2 questions. Mr. Puffy has 2 questions, 1, 2, and 3. I'm reading that right. 2 questions, 1, 2, and 3. Okay. Oh, third one, not a question. Okay, I take that back. I was making fun of you there. I totally understand that we should be focused on what the Fed members are thinking about rates going forward, and they've been covering it extensively, but I'm still curious as to what your view is on the no rate cut stance. Is it aligned with or does it diverge from the Fed's consensus? That's the consensus view. Almost to a person. No rate cuts. Not till, and some are saying we don't see rate cuts till maybe mid to late 2024. Raphael Bostic, not till mid 2024 would he consider it. He said, and we may even have to go higher from here. There's no guarantee that we're at a pause. So, no rate cuts. No rate cuts if everything stays the same. But the longer this 3-month to 10-year inversion hangs around, the more likely something will break. It will break. And then there'll be no choice, because nothing cures inflation like massive increases in unemployment and a deep recession. Nothing cures inflation like that. And at that point, the economy is the bigger problem. Rates will be cut. Comment on last week's update. You sort of recognize the U.S. healthcare sector as a potentially overperforming sector in the long term given the many tailwinds, aging population, strong demand from foreigners. Do you think overall stronger support from Democrats among the younger generations, which could potentially result in more regulation on pharmaceuticals and imposed profit ceiling, represent a major headwind for healthcare? Yeah, you can always count on the Democrats to not understand the profit motive and not understand why companies invest in innovation. You put a profit ceiling on something, you could say, okay, well, which life-saving drugs do you want us not to research? Which one? You pick which life-saving drug you want us not to research, and we're fine with that. Democrats think they're helping, but they never understand the unintended consequences of their actions. I don't know why. I don't know if it's just for show. I don't know if they just if they're just performing liberalism, but they don't really truly understand what they're doing. I don't understand it. It never used to be this bad, but here we are. I think that would be hard to get through, because in the end, every politician needs money. Every politician has to raise money, and these guys got a lot of money. So, you can either fall in line or they'll run a candidate against you. And that's really what it comes down to. So, there is nothing wrong with performing a little bit of outrage for the cameras, right? I mean, most politicians, what they say is performative. I mean, I don't think that, I think for 90% of the shit that comes out of their mouths, I don't think it's real. I think it's because there's a camera and they're performing outrage, or they're performing a liberalism for the camera, and then that's it. And then 2 minutes later, they forget what they said, and they go sit in a room with some pharmaceutical representatives and take their donation check and say, sorry about that, but I got to say that for the cameras, right? And I think everyone knows the game. I don't know why we believe a single word a politician ever says. There's that old joke, how do you know a politician is lying? Their lips are moving, right? Not a question, just a comment. I was listening to last week's Rational Reminder podcast, and Ben Felix made it a point that covered calls are not as attractive a strategy as some may think. He even says that premiums can't be considered income because option premiums are offset by the liability of selling underlying below market value. Well, true. I mean, you have to be careful on what you're selling covered calls on, right? My thoughts are, obviously there's always risk, but if writing covered calls are done in a way so as to avoid all possible assignment, low delta, technical analysis, closing them at a gain, then in substance they should be considered income for the person doing it. Yes, they should. He's clearly preaching the passive approach to investing. Yeah, he is. Nevertheless, I do believe in the power of options and derivatives when used responsibly. And when you're using these strategies, you're playing the odds. You have two distributions that you're playing, and the odds are even better when you understand the distributions. You have the distribution of actual returns. This is realized vol on the underlying. Implied vol typically has a wider distribution, so that when you're doing, let's say, 20 deltas on either side of the implied volatility, let's just do the realized vol a little bit better. That 20 on the realized vol might only be somewhere around 15% on either side, right? So you may have 20% in each tail on the implied vol, implying a 60% probability of profit if you sell the call and you sell the put. Whereas in actuality, on the underlying, on the actual realized vol, because IV overstates it, you might actually have a 70% probability. So that if you do this on enough underlyings, you will win 70% of the time, you'll lose 30% of the time. So if you take your gains at half the profit, that's like 35% full profit, and you take your losses at, if you sold it for $1, you take your loss at $2, you have a loss of 30%, you have a gain on 5%, so you're doing it on volume. It is an income strategy, and you can do even better if you say, well, let's go with 10 on either side. Now I have 80% based on implied vol, but it might be as high as 92, 93% based on realized volatility. Well, yeah, I mean, if you understand those distributions and you know how to manage your risk, yeah, it is income. But he is right. I mean, you can sell calls on something and the underlying goes up, and you're giving away some of your upside. But in selling the call, you were also protecting some of your downside. That's the deal. Is if you want some downside protection, you got to give up some upside gain. That's the symmetry at which risk works. Since you use the U.S. bankruptcy filings by year chart from S&P Global, I'm curious to know if you use that website for any market research. Yeah, they do have some good stuff. Yeah, they do. Do you also have an S&P Capital IQ Pro subscription? No, I don't. But if you have the Koifin subscription, their data is from Capital IQ. So you are, in a transitive way, getting Capital IQ data. But no, I don't have the pro subscription. I did contact S&P to pitch them on the idea of, listen, I have on our website, we have, I don't know, some 30,000 charter, not charter holders, but CFA candidates. I have a significant enough audience of CFA candidates and charter holders that if you give me the pro subscription for free, I can incorporate a lot of that data into what I'm doing and tell people where I'm getting it from. And it would be great marketing. So somebody then had a meeting with me, and of course he was at home. He was in his t-shirt with a stain on his t-shirt, and you heard his kid screaming in the background. He says, oh, that's not really what I'm in charge of, but I'll pass it on to someone and I'll send you an email to let you know who I pass it on to. He never sent me an email that he passed on to anyone. I sent him an email a couple days later saying, where are we on this? And he just said, the person I contacted said, we don't do that. And I thought, well, see, this is work from home now. This is what happens when you work from home, is my work got in the way of your home life. Work got in the way of your home life, and you just dismissed it all. Come on. But this is work from home. Had everyone been in the office, I probably would have been in front of the right person and was able to pitch it to the right person and say, here's what we can do. We can incorporate some of your data in the CFA videos. We have well-placed people at level 3. We have, we have eyeballs, the kind of eyeballs, the qualified eyeballs that you guys want. We've got them. And just to have some individual who decided that work was getting in the way of their home life to dismiss it on behalf of the entire organization, to make a decision on behalf of the entire organization that, no, we don't want that kind of exposure. I got things to do. I got laundry. I got dishes to do. Can't you hear my kids screaming? You're calling me in the middle of the day? How dare you? Work from home, right? Work from home. You know how I feel about that. It's not a thing. 2 questions. If we accept the base case scenario of a recession in the near future, isn't a long position in COPEX against that? Yeah, it would be. For 2 to 3 quarters, it would be. I'm saying this because commodities tend to suffer in recessionary times. If you're bullish copper long term, perhaps short puts 10 to 15% below the market would be a better play. That is what I'm doing. I'm selling puts on COPEX, but I'm being aggressive. I'm selling at the money because it is a narrative. Copper's a narrative out there. Much like AI is a narrative, copper is a narrative. I think it'll hold up fairly good. So I'm being aggressive by selling at the money. If they are put to me, I'm good with that. I am good with that. I don't mind holding it through a couple of quarters. But I don't know if I'm going to be right. I don't know if there is going to be a recession. I don't know how deep it's going to be. I don't know when it's going to be. I don't know if copper has 20% upside before a recession happens. I don't know any of this stuff. So I'd rather at least have my toe in the pool to say that at least I was at the party, right? And if it does pull back, then, if we do get the recession, then I will add my full position at that point. But I don't want to give up the income of being able to sell puts against it. And so far, the puts I've sold against it are both in the money. Not in the money. They're both showing profit, meaning they're in the money in my pocket, not in the money in the market. They're out of the money, meaning that I am making money on the puts as it is right now. Let's see. Second question about credit market. Not interested in high yield because I don't think the risk premium is high enough to compensate for the potential risks in the horizon. Regional banks, commercial MBS, credit drying out. However, investment grade seems like a decent place at the moment. ETF LQD has a yield to maturity of 5.2. I wouldn't say it has a yield to maturity. It has a yield of 5.2. I don't know about a yield to maturity on the ETF, because the ETF will target a particular duration and continually reinvest yield to maturity is if you're holding a particular asset or portfolio of assets to maturity, and that's it. But it's going to do more than that. It's, you have assets that mature every so often, and that's they re-add to those particular assets. So 5.2 yield perhaps, average maturity of 13 years, average duration of 10, average credit quality of A, not bad as long as a long-term core allocation of retirement portfolio. What is your opinion on investment grade at the moment? Yeah, I think so. Their credit spreads don't tend to widen as much as high yield, that's for sure, but they do widen. They are more interest rate sensitive than credit spread sensitive, so that their empirical duration would approach their modified duration or their effective duration. Yeah, I agree with that. And should any of those exogenous risks materialize, do you think the risk premium will raise more than the drop in the long end of the curve? Well, spreads will widen, but even on high yield, depending on where they are now, you might get 60 basis points, 70 basis points of spread widening on investment grade. But you could get 200 basis points of cuts on the front of the curve if something breaks. So I think they would benefit. If the market comes around higher for longer, no rate cuts, how does that impact the long end of the curve? I think the long end of the curve stays inverted because if you are higher for longer, I think the easy bet is something is going to break. Something's going to break. You're right about saying they are not cutting, but they have to say that as if they said they will cut. This whole fight against inflation will blow up. Well, yeah, I guess you could look at it that way, that even if they wanted to cut, they actually couldn't say they were going to cut. But I don't think that's what they're doing. You don't raise rates all the way to one meeting, take a meeting off, and then begin to cut rates thereafter just because you had 1 or 2 months of inflation that wasn't going up anymore. No, I think what they're saying right now is not poker. I think they're actually showing you their hand and saying, we're not cutting rates. We're not cutting rates. When reading through CPI data myself, I see what you see, increases across the board for the most part. Month over month, yeah, doesn't look great. However, when you read through Bloomberg, turn on the news, everyone is throwing a party. It seems as though the numbers are below expectations. Year over year, they were below expectations, but month over month, it's not a good trend. It's almost a reversal of the gains that were made. Do you think the expectation numbers for CPI in general are just a load of... well, I don't know. I think, when the data comes in, I think the market picks and chooses what it wants sometimes. You get year-over-year numbers that increased. The narrative is, yeah, but look at the 3-month, look at the 1-month annualized. It's all coming down. Year-over-year, that's backwards looking. Well, this time, if you look at the month-over-month, it was going up. Oh, but year over year is coming down. You got to look at the year over year. Well, pick one. You can't just treat this like God and say there's a flower, there's God's work, there's a dead baby. Well, there's God's work. It can't all be God's work, right? So you gotta. Inflation is not like that. I mean, pick a story. But economic data is kind of like that. Is no matter what the data says, you can weave a story to fit your theory. Or to fit the narrative. If you're long only, all the data is positive because you can always find a reason why it's positive. Well, this data came in negative. Yeah, that's the bottom. It all gets better from here, right? Won't a debt ceiling extension trigger the U.S. government to issue a substantial amount of debt to finance its expenditures, resulting in the yield curve shifting up? So a lot of supply coming onto the market is what you're suggesting. And if we look at auctions, the bid to cover on these is incredible. Even in investment grade, bid to cover is like 2-3 times. You have an IG company that's issuing $30 billion, and there's 80, 90 billion dollars worth of money lining up for that $30 billion worth of bonds, because government bonds are getting scarce. So if a lot of bonds came to the market, the money would show up. So I don't know that it would lift the curve that much. The demand is there. It's just, why show up if the supply is in there? But the bid to cover ratio right now is still strong. I'm having trouble tying the two components of velocity of money to a restrictive monetary policy. I'm not. I don't know. I don't even know what this question is asking me to do. You'd have to be a lot more specific than that. It's like saying I'm having trouble understanding, A in relation to B. Well, what part of A and what part of B, right? This is just nowhere near enough. I don't know what you think you're asking with this. Like what's the picture in your mind that generates this question? I don't know what that picture in your mind is, so I don't know. You said if something breaks, it has to be in the credit market. Well, it doesn't have to be in the credit market, but for the Fed to dramatically cut rates, something would have to break in the credit market. That's where the Fed would respond to right away, because as soon as you hit credit, a lot of bad things happen very quickly after that. Many alternative shops are upping their private credit game. They tend to call this IG credit. I simply find it hard to believe that these alt shops can do the same level of credit analysis that traditional banks did on a periodic basis. 100 people on board compared to banks' credit market risk teams with thousands of people. Also, they say they would have long-dated liabilities, so it wouldn't be a problem if something breaks in the short run. And that's true. If you have a long-dated liability, it's not a problem if something breaks in the short run. So in a way, they can provide capital to businesses which banks are exiting because of various reasons. Private credit is going to have a limited life. I don't know that you have 40-year private credit. Most private funds have a 10-year life. Even private credit is going to have a 10-year life. Where you have capital calls, money comes down, you buy these levered loans, and then you hope to be out of them. And even high yield issuance tends to be under 9-year issuance. There is no 20-year, at least not that I'm aware of, 20-year high yield issuance. So I don't know that it would be that long a period of time. And private credit that was issued 8 years ago is trying to get out in the next 2 years. So they also have. It's not as if they're just immune to the whole credit thing altogether. If credit, here's the thing: if credit dries up, asset prices will drop. If asset prices will drop, funds that allocate money to the capital calls for private credit will pull that. Will not meet those capital calls because they're liquidity, because they'll be more concerned about liquidity at that point. So I don't know that they're immune to these things. I think that if they're willing to lend money for a long period of time, they're less immune. But are they willing to lend in an environment where credit becomes extremely risky? Because they have to get their money from somebody else. And is somebody else going to continue to give them that money under that environment? So I'm not sure that the argument is as great as they make it sound. So in a way, they can provide capital to businesses, banks, for various reasons. Maybe it's true, but it kind of feels like red flags, as I've seen many marketing materials over the past month on how safe and excellent private credit is and as an investment. What's your view of private credit? Well, it is like, any other fund. You go to large investors and you say, I have an alternative for you. And here it is. And these investors are going to want their money back over some period of time. Usually it's 10 years, so there'll be capital calls for the first couple of years. There'll be investment in these loans, and then there'll be an exit out of these loans. So you have to forecast, well, what will the environment be when they're exiting their loans? So you could say, well, we can make a loan now, and if it matures in 8 years, if any credit breaks in the next couple of years, it doesn't bother us. And that could be true. But at some point, it has to be paid back. Well, that's the environment you have to worry about, right? I don't think it's as simple and easy and wonderful as the brochures may make it sound. Let's see. You found a possible investment opportunity. French mining company Constellium. Constellium is the company. Let's see. I have here two questions. 1, 2, 3, 4, 5. This 2-question business. Like, I'm not going to notice you got 5. 2 questions. Let's treat this like a CFA exam. 2 questions. We'll answer the first 2 questions, and then that's it. You mentioned that you watch live speeches by Powell and monitor how SPY reacts. Well, because as he's talking, you have it up beside you, right? Where do you do this? Okay, so where do you do this? I'll answer that three ways. I do it right in my own house. Number 1. I do it right on my computer. Number 2. I do it through Interactive Brokers on one screen, and on the other screen, when Powell is speaking, if it is live, if you Google Fed speeches calendar, you'll get the calendar up, and there will be a link where you click live. For example, Powell's conversation this Friday at 11 is live. It will be broadcast live. You can just click on that, and that's it. So I think I answered the where part in as many ways as I can interpret it. I usually tune in to CNBC, NBC. You can get it right through the Federal Reserve feed itself. Like, it has its own YouTube channel, and it handles its own live feed itself. Let's see. The past market outlook, you frequently talked about the narrative that would guide the market as the week progressed. How do you read the market narrative? I typically follow CNBC's breaking news, but I can't deny they'd be quite misleading, as they tend to simply correlate any significant market movement with whatever news is currently relevant. What would be a reliable source or criteria to read the market narrative that is fueling the market? I watch Bloomberg. I have Bloomberg on. And I watch that, and the guests that are on any particular day are I guess trying to find good words here. I find that they blow in the wind quite easily. A lot of them. That if the market is moving in a particular direction, there's reasons why it's moving in that direction, or this is happening, or this is going on, and all of the talk tends to be one-sided. And when the market's selling off, everyone seems to be on board of why it's selling off. So it really comes down to, you can look at other indicators too. The Fed funds. The Fed Watch tool on the CME, you can watch that. You can see the probability shifting from 25 to 0. You could look at the Fed funds futures curve. You could see that it's increasing, meaning that the implied rate is decreasing, and that feeds into the conversation. I don't know. There's no one thing, I guess, that I could say, look at this or look at that. It's a constellation of everything. It's a constellation of how the market is moving, what is being said, what the major headlines of the day are, what is fueling the day. Today, Home Depot started off the day with some negative news, and that kind of just continued to carry through. So that weighed on it, along with retail sales, which it came in at 0.4, but inflation came in at 0.4 as well. So if you think about it in that respect, with unemployment at 3.4% and wage wage growth at 4.8%. All you could muster was a 0.4% in the month. That's all you can muster. That doesn't sound robust to me. It's just a constellation of things throughout the day. Regarding the outlook for the week, if the Fed cuts rates due to some financial disturbance, what criteria would you use to assess whether the disturbance is significant enough to outweigh the rate cuts? If the Fed cuts rates, how would I assess whether the disturbance is significant enough to outweigh the rate cuts? Oh, I see what you mean. If the Fed is cutting rates, it's ugly. The Fed's not going to cut rates just to cut rates. The Fed is going to cut rates because everything is ugly. And usually when the Fed does something like that, it's intermeeting, which means they'll announce it at like 8 in the morning or at 8:30, we're cutting 50 basis points because it's bloody and it's ugly. Usually once they announce it, there's going to be a rally on that. That fades away in time, but there will be a rally on that. There typically always is. Even in 2008, whenever they mentioned we're cutting, we're going to cut 75 basis points this morning, you get 1,000 points on the Dow that day. They were just never-ending rallies, just money flying right back into the market. But it had several issues like that before it finally bottomed out at 666. If they are cutting rates intermeeting, it means that something really, really bad has happened. I mean, really bad. So let's just pass on that. When it comes to raising the ceiling, won't that help with people being employed and overall work against what the Fed wants? So then they would be less likely to cut. Raise the ceiling. Won't that help with people being employed? You're going to have to tell me how you're making that connection. Raising the ceiling, helping with people being employed. I don't have the math to make that work, so I'm going to pass on that. How do you reconcile your strategic position on home builders with a view of the upcoming recession? Are you comfortable buying them at almost all-time highs? Well, not really. I'd rather get them at a lower price, but they're not giving me any opportunity at all. Today, almost all of them were hitting 52-week highs again. They're not giving me an opportunity to get in. They're not pulling back, so it is what it is. I think they could survive a recession very well. Keep in mind that even in a recession, if you get 9% unemployment, you're still talking about 91% employed. I don't know. I think they'd pull back in a recession, but I just don't know if they'd pull back that much given the structural shortage that exists. You have to get involved somehow, right? So I'm selling puts, 30 delta puts on Lennard, DR Horton, and the XHB on a 2-week rotating basis. Well, every week, 2 weeks out, every week, so that I have two series out at any given time. Hopefully something will be assigned to me, but if this continues on, then I'll just be making income by selling the puts, but you have to get involved somehow. I still have short beta at the portfolio level, so even if I have long underlyings, I'm not going to suffer, because as the market goes down, if those underlyings go down, my short beta is going to be paying off. Being a recent spike in the price of credit default swaps and U.S. Treasuries. For example, the cost to insure 1-year U.S. Treasury spiked from 2 basis points to a bit over 150, really? This seems like a great opportunity to actually sell. You cannot sell. It's OTC, and you need to be either a bank or an insurance company to be selling. Even in the most unforeseen of circumstances, it seems infinitely more likely to me the Fed would print hyperinflate in order to pay on U.S. Treasury obligations rather than default. Well, first of all, it's not the Fed that would lose credibility here. This is the Treasury. This is Congress. The Fed has nothing to do with this. Yeah. Obviously, the biggest bear to the strategy is knowing how to have access to selling those products. You can't do it. You can't do it. Let's see. On Drucken is coming on copper. His position that he didn't have a meaningful position due to the potential downside. Yep, too early for COPEX potentially. For him, probably. Also, former hedge fund manager Russell Clark on TLT. He has it as a short. Structurally higher U.S. rates going forward. Duration constraints on the ETF. And record low short interest are his reasons. Yeah, well. For every buyer, there's a seller. That's what makes a market. For everyone that thinks one thing, you'll find a group of people who think something else. I just happen to think something else. That doesn't mean everyone's on the same side of the trade. He has his reasons and I have mine, and time will tell which one of us is right. Equities market has done absolutely nothing so far to price in or hedge with volatility and any potential consequences of the debt ceiling not being resolved. Yeah, I agree. Yet nonetheless, there's no doubt that equities market will pop higher once an agreement is reached. It's not easy to be bearish in 23. No, it is not. I heard in the podcast that only big names such as Apple, Google, Meta, Amazon are keeping the SPX afloat, which is due to the buzz in AI. That is true. I looked at year-to-date heat map, and it seems doesn't 100% correct, but reasonable statement. Yep. Then there's a possibility that something breaks and the Fed starts cutting rates. Should I start unwinding my short position in SP June 23? I can't advise you on what to do. I have short positions. I added to my short position Monday night after the close. I thought, well, this was a ridiculous day. This made no sense. So I added to my short position. I'm not unwinding. Is PPI a good predictor of CPI at T+1? Well, PPI is, there's two different parts of it, right? There's the final demand, which is the prices received. CPI is the prices paid. And prices paid have within it taxes, all that kind of stuff. It's what the consumer actually pays. Whereas prices received is net of all that stuff. So it's measuring, like this couch got sold. CPI will measure it as the price the consumer paid. PPI measures the price that the seller received. So it's not that it needs a lag for the final demand. When it comes to the stages of production, stage 1 through to stage 4, I'm not really sure what the throughput is on that. To be honest with you, I don't know what the lag is on that. Trying to form my own opinion as to why you have always told us. I don't understand the appeal of agency. Looking at the recent 10K, they have a weighted average yield on assets of 3.55. Basically the same as holding an intermediate term treasury. Keep in mind the yield on assets is 3.55, but they use leverage, right? Lots of leverage. So it's not the same as holding an intermediate term treasury unless you can bring 7 times leverage to it. Furthermore, it's leverage and borrowing at higher cost. So the interest expense is higher than the interest income. No, it's not. No, it's not. No, it's not. Don't know what to tell you there. They will not be paying any forward dividends out without earnings. If I'm understanding how a REIT works, they have earnings, almost record earnings. This last quarter was, I think, the second best quarter they've had. The quarter before was I think, almost record earnings, at least going back a number of years in terms of their net interest and dollar roll income. You got to ignore the net income because there's going to be unrealized losses, fair value to P&L. The fair value changes in their assets hit P&L. So you're going to it's going to look like there are losses, but you have to look at the cash flow from operations and you have to look at their funds from operations. And no, none of this is true. Options premium is high, but how does the situation revert for a positive outcome? Okay, so what I'm seeing here is that you don't quite understand exactly how agency is structured and exactly how mortgage REITs are making their money and how to measure the profitability of a REIT. So I would strongly recommend that if you don't understand the appeal of agency, then probably other fights that you can fight than this one. If you don't understand it, don't do it. Because if you don't understand it, you're not going to understand when it's no longer valid, when the investment thesis is no longer valid. So if you don't understand it, yeah, it's probably safe to just ignore the whole thing. So I will scroll past the rest of this. Is SPY stalling at 415 with an 18.5 because Howard hasn't updated? Yeah, it could be, eh? Why do you sell out of the money puts? If you sell a few in the money puts or closer, wouldn't that be more expensive and you will get more money? Yeah, but you also have a higher probability of being assigned. And the only reason you'd want to sell an in the money put is if you really wanted to be assigned or you believe the underlying was going up. Because let's say that it's in the money for $3. The premium's $3, but it's $2 in the money. Well, your time value is only $1. But if you can sell an out of the money put for $1.20, well, it's all time value, right? So you'd have to have some belief that the in the money component is going to disappear such that you would make more than just the $1 time value. So I prefer just to have all time value instead of any intrinsic value, unless I'm really trying to engineer it being put to me at a lower price than I could buy at spot. The CDS value is the CDS price. It's, yeah, basically. Just want to hear your thoughts on can we do better versus AI learning creativity. We often ask ourselves, can we do better? And now AI is here. Do you think AI will make up most of the potential upside that humans can do? No, I don't think so. Well, let me answer that again. At this point in time, I don't know the answer to that. As of right now, I don't think so. But this is a fast-changing technology, and in 3 months, new facts may be out that change my mind. But the facts right now, I would say, I'm, not yet, but it's getting there, right? Let's see, U.S. Treasury up 2, FRM down 4, so spread should be -6. U.S. Treasury got up by 2, yeah, spread should be -6. 2 questions about agency. Last couple of years, price of agency has been going down in part because MBS spreads have been widening significantly. True. My opinion, a key factor for this widening has been quantitative tightening, on which the Fed has stopped buying MBS as aggressively as before. I don't see that, because if you look at MBS issuance for the last year, MBS issuance has gone straight down. So you don't need a big buyer because the supply just isn't there. So even though the Fed is no longer buying it, the contraction in MBS issuance more than outweighs what the Fed is not buying. No, I wouldn't take that. As a result, the private market must absorb the excess. There's actually a shortage pushing up MBS rates. If we believe Powell and the Fed will continue QT for the foreseeable future, doesn't that prolong the downward pressure on the price of MBS? I don't think it is the runoff, because the runoff is too slow. In MBS, I think they have a cap of $35 billion, and they're not hitting anywhere near the $35 billion each month. And issuance is down some 70%, 80% year over year on MBS. So no, I don't think that's the case at all. What is your take on book value per share being significantly higher than the spot? Yeah, book value per share is possibly an attractor point for the stock, but it doesn't mean it is going to trade there. It can be sentiment driven. Sometimes good stuff gets thrown out with bad stuff. Yeah. So I'm comfortable with it. I'm getting a lot of questions on agency. Let me just say this as clearly as I possibly can. If you are not comfortable with it, don't do it. Don't do it. There are other things that you can do. I'm comfortable with it, so I do it. I do these market outlooks to show you the process that I go through from a top-down perspective, and how I come to my assessments of where I want to be. so that you can start thinking in those terms as well. It is not a recommendation that everybody go out and buy agency. If you hear the argument that I put forth and the argument resonates with you and you say, okay, I understand that, I see what's going on, I understand what this thing is, then go ahead and hold it. It pays $1.44 a year. For me, that's a beautiful source of income, and it goes down, it goes up. I'm comfortable with it. It fits with what I want to get done. If you are uncomfortable with it, if you're concerned because the price is dropping, if you need reassurance all the time, I don't want to be that guy that has to answer frantic emails every day, giving advice. And if you're not comfortable with something, don't do it. And I'm the same way. If I'm not comfortable with something, I don't do it. No matter what people say, I'll look at it and go, I don't understand it. I'm not comfortable with it. I'm not doing it. So I would say, let's just, don't do it. Let's see. Any opinions on residential REITs, Armor? I'm out of all REITs. I am out of all REITs. I've said that before. All equity REITs, I am out of all equity REITs because the REIT space has not got the message about higher for longer. And they have bond-like cash flows, and they should be pricing like bonds, and they refuse to do it. So I am out of it. Page from Book of Lionel Hutz. I don't know who that is, but wow, that intro feels really intense. God dang, that opening. Thought I was watching the wrong video because of the new intro. My phone is ringing here, and it is one of those 1-866-888 something numbers. I've had a whole bunch of credit calls for Madonna Blanchard. So Madonna Blanchard, if you're out there listening, seriously, giving out my number on credit applications and then not paying, and I gotta answer all these questions. Anyways, Madonna Blanchard hasn't been paying her bills. I assume it's a woman's name because of Madonna. But Madonna Blanchard has not been paying her bills. There, I'm telling everyone now. Did you ever get a new Corvette? No, I went last year. It was a 3-year waiting list. I would have been 181 on the list, and this dealership got an allocation of 50 a year. 3 years. Nah, I wasn't going to put money down and then wait 3 years. Opening animation is really bad. Yeah, well, I got other people saying they like it. So I'm going to try out a new one this Sunday, and then you guys can pick which one you like the best. But I do need an intro because I, feel I do need an intro. Marketing says to me, you could use an intro. And I said, we tried this like a year and a half ago, put an intro on one video, and no one liked it. So, okay, I'll try an intro. But here's the thing. I think if I come up with a nice, simple intro, that after a couple of months of that intro, it'll just be that you can't imagine it without the intro. And just as a little teaser, if some of you remember the cartoons that were in some of the CFA videos with Rodney, Rodney is coming back. Anyways, that's the end of this week.